Our guest expects a cut from the Bank of Canada. Let's get more from Dominique Lapointe, Director of Macro Strategy at Manulife Investment Management. Dominique, thanks very much indeed for joining us. You think the Bank of Canada will cut? They are running out of room, though, to keep reducing interest rates, aren't they?
Well, it depends from your reference point. If zero is a zero lower bound, we're not going to get there, but they still have a lot of room to cut. However, if we look at their own framework to see where they could cut without necessarily being overly stimulative, 2.5, 2.25 looks to be the lower bound there, that they're going to be comfortable cutting without necessarily thinking that once we get past this soft moment, it would lead to inflation down the road.
Is there a real risk, do you think, of inflation reigniting significantly in Canada?
It was a big question at the beginning of this year. We've had several of the core measures that the Bank of Canada is looking running too hot and showing signs of acceleration. It was hard to pinpoint an exact reason. We've had the counter tariffs put in place, a weaker Canadian dollar, past wage growth. We think was still filtering through like wage concessions and prices this year, but look at all these three, they're pretty much gone at the moment. The Canadian dollar has been fairly stable since we've seen wage growth slowing. And so companies don't have a lot of pricing power at the moment. We don't think they're going to get more within the next 6 months. So for the Bank of Canada to cut today and then another time this year, we don't think it causes a big risk for inflation next year.
With the Fed also set on deck today to potentially cut, likely see that as well. What do you think the chances, or how much do you think the Bank of Canada is currently influenced by the Fed, especially with the divergence risk we're seeing and even the FX implications of the Fed? Do you think they are have any sort of implication on the Bank of Canada's decision?
I don't think so. I think if the Fed would be in a position where they wouldn't cut today, even next month, if you're honest about the Canadian labor market data we've received this summer and the moderation in inflation data that we've had, we think that the Bank of Canada would be focused on that as priority. Now, to your question about the gap between where the Fed and the Bank of Canada could go, even if we are in a large gap environment now, it wasn't never really discussed by any Bank of Canada official what that limit would need to be. But you need to think about it the way it would be reflected through the currency. And at the moment, what we see is the Canadian dollar being fairly stable, and the U.S. dollar actually has lost some status this year. And I think the chances are that the U.S. dollar depreciates even a little bit more. So that wouldn't necessarily be conducive of imported inflation in Canada.
Give us that again. So the U.S. dollar goes down. It makes it cheaper to bring in stuff from America. So that's good on the inflation front.
Yes.
What about, I know we're getting off the Bank of Canada here, but what has been pressing on the U.S. dollar, do you think?
I think it's in 3 stages. So you've had Liberation Day on April 2nd, like very risk-off sentiment in market, and we looked at is global investors starting to hedge a little bit, an historical large unhedged position that they've had in U.S. securities. The euro by itself also gained a lot after some major fiscal announcements, and even we're following that closely. It's coming through in terms of defense spending, but also other types of stimulus, largely out of Germany. And then the next leg would be the Fed, exactly where the market is priced in aggressively rate cuts for the summer. But we think that there's still downside risk to that market pricing, given the fact that the president has said that he wants rates to be much lower, and that would imply lower than 3%, which is where the market is at the moment.
I think with the real estate market too, there are a lot of investors, this dislocation between buyers and sellers, and a lot of people are still waiting, for more rate cuts to come out of Canada. What do you see? Obviously real estate will be an asset class that will benefit from lower interest rates, bonds, financials, et cetera. But what do you see prime potentially coming down to for Canadians who are, maybe looking at renewing their mortgages or are potentially looking at buying properties, let's say over the next 12 months?
Yeah, so we think now and until the end of the year is an interesting point. It's not a financial advice per se, but when we look at like prime mortgages, prime rate you've mentioned, it's going to go down at least 50 basis points based on the 2 cuts. And then the 5-year fixed rate mortgages, it's around close to 4% right now. If the U.S. economy slows down a little bit more, which we think it will go, maybe there's a little bit less downside risk to that yield, which would imply that 5-year fixed mortgage rate in Canada would go down a little bit. But to envision a rate environment for mortgages where it goes down significantly below 4%, we need a larger economic drawback in Canada, say a proper recession. And that's not something we want. That's not something a homeowner wants for its equity in his house. So that's why I'm saying at the moment we have, especially in the Toronto region, still some concessions made on prices, and rates are coming still down a little bit. It looks interesting if you can actually be in that segment. Montreal is just keeping more and more expensive despite everything, but we think that it's going to get more expensive because the supply is not built, it's not there as much, and also prices are still cheaper than where they are in other markets.
Thank you very much, Dominique. Really appreciate it.
Thank you.
Dominique Lapointe, Director of Macro Strategy at Manulife Investment Management.